So 22.
Songa.
The 280 minus 2040. You get to 40. That's our increase. Decrease, I mean. Decrease of to 40. The next thing is our trade payables. Trade payables account. Because this is a liability, so it has a credit balance go down and a debit balance carry down. So the credit balance go down and debit balance carry down. Here being the balance here is 2900. This is becoming 3200. Razak came with 320, and this person went with Razak came with 880, sorry, 880. Then Salama went with 320. So again, we're going to look at if there's a decrease or there's an increase in this. So this will be 35, 36. So to 900 plus 880, you get that 780. That's 780. So minus 3200 minus 320, you get to 60. So there is a decrease. There's a decrease of 260 in trade payables. And then let's look at now the next thing we can look at taxation account. Taxation account. And of course, you know that all these taxes are tax liabilities. So balance go down, we are going to have for current tax and deferred tax. Current tax and deferred tax. Again, balance carry down. We are going to have current tax and deferred tax. So current tax is how much? Current tax was 1440, balance go down. And deferred tax balance go down was deferred tax was 420. Current tax on this other end was 1600 and deferred tax was 600. And then of course let's look if either the company came with a tax liability. Razak came with a tax payable, tax liability. Razak came with a tax liability of 160. And then Salama. Of course, Salama did not come with any, we did not dispose any tax liability for Salama. So we can also look at the amount of tax in the P&L account or in the statement of comprehensive income. So the comprehensive income was 900. So if you balance off that account, you want to know how much tax, how much cash they paid for tax. So 1440 plus 420 plus 160 plus 900. You get 2920. So minus 1600 minus 600, 2920. So cash paid or tax paid. So the cash that they paid for tax is now giving us 720. So that was tax. So we remain with how to account for NCI and also the dividend that was paid. And then we are going to find those are working. working so that we can consolidate. So I'm going to rub this question, the first one, so that you guys can find out. Let's run for non-controlling interest account. The non-controlling interest account plus the retained earnings account to enable us to know how much dividend were paid to the majority shareholders. How much dividend were paid to majority shareholders, and the one that were paid to minority shareholders. Majority shareholders and minority shareholders. Majority and minority shareholders. So we are going to do our workings here to ensure that we get the majority shareholders. So let's start with the minority, the NCI account. NCI account. Of course, this is more of a equity. So it has a debit, a credit balance brought down, and the debit balance carried down. So we are going to have a balance brought down for non-controlling interest was non-controlling interest is in the equity side. It was 1280. Balance brought down is 1280. And balance carried down is 1240. Carried is 1240. And then let's look at Razak. Razak, of course, we are going to also apply the NCI fair value to know how much fair value this company came with. Razak, the NCI fair value for Razak, we were told to be 1360. 1360. Note number 1, 1360. And then Salama, the fair value was 1280. 1280. And of course, we are also going to look at the P&L account. P&L account, how much was paid. So we can look at the earnings attributable to NCI. Earnings attributable to NCI was 380. So we'll add 380 there. And then we see how much dividend was paid to minority shareholders. How much dividend was paid to minority shareholders of the non-controlling interest. Okay. So we are going to have there this total into 3020. 3020. Then minus 1280. Minus 1240. Minus 1240. Okay, there's a share, there was a share which we computed. There was a share of all this. Let's use the amount of share capital that we had. This was the time of disposal, at the time of acquisition. These were the fair values at the time of acquisition. Let's look at their current values. You know that Razak came with the fair value for Razak, the net assets for Razak was 1590. So 5960. That was for Razak. Razak came with 5960. But since Makongeni was controlling 80%, then 20% was minority. 20% was minority. So 5960 is 0.2. You get 11. Of course, we can also use the fair value at that time. For that, this was also the status at the time of acquisition. At the time of acquisition was okay. We can just use 1360 because that's what we used for Razak. Because that was the fair value at the time we acquired it. Now, for Salama it's different because Salama, the fair value at the time of acquisition is different from the fair value at the time of disposal. So we are going to have for Salama, it will be 3920 times 40%. Since we are controlling 60, so times 40%. So 3920 times 40%, we get 1568. 1568. So Salama is 1568. That was the net value at the time we were disposing Salama. So this will so 3020. Let's find the dividend paid. Minus 1240 minus 1568. You get 212. So this dividend paid was the one that was attributable to the majority shareholders. But of course, there was some revaluation here, where we have revaluation of PPE, which was coming there to be that. Anyway, so let's look at that. Let's look at dividend paid to majority. Dividend paid to majority. So dividend paid to majority, the first dividend. So we find that by running retained earnings account. Retained earnings account. Of course, balance go down for retained earnings account. Retained earnings account was 4340. And then balance carried down for retained earnings was 7020. And then P&L account was 3180. So our dividend will be 4340 plus 3180, get 7520 minus 7020, you get 500. So dividend paid, so this dividend paid to majority was 500. I think from that point we can now consolidate. This financial statement. You can consider this financial statement. Now you guys will help me find the dividend paid to majority, to NCI, and also cash paid. Sorry, I was not mentioning the workings. So let's start by consolidating this cash flow statement from these activities. When you start by there was also loan. You can see there's a difference in loan from, we just complete that one directly. So Makongeni group, and we have consolidated statement of cash flow. For the year ended 31st October 2019. 31st October 2019. So we are going to have got consolidated cash flow from operating activities. Of course, can have millions, then shillings in millions. So the first thing is profit before tax. This is I7, profit before tax. So our profit before tax was 4460. 4460. Then adjustments, that those adjustments that you want to run. Adjustments. Under the first adjustment, we have gain from disposal of subsidiary. Gain of disposal of subsidiary. Gain from disposal of subsidiary was how much? If you look at the income statement, it was coming to be 400. So that is an uncashed income. So an uncashed income, we deduct that one. We can also look at gain on disposal. Gain on disposal of PP. Of course, remember there was a PP that the carrying amount was 1 million. 1 billion, and then it was disposed at 1.1 billion. So the gain becomes 100. You also deduct. And then of course we have also depreciation. Depreciation of PP. We found this to be 1540. This is a cash expense, you add it. Then we have got share of associate profit. Share of associate company profit. Company profit, which was the question they gave us to be 460. So those are non-cash incomes. And then we also have got impairment loss of goodwill. Impairment loss on goodwill. We found it to be 320. If you look at our previous workings, you'll find it was 320. What else do we have under operating activities? I don't think there was any other one. So let's work out that one to adjust. So 400, negative 400, negative 400, minus 100, plus 1540, minus 460, plus 320, get 900. Getting here to be 900, which is positive. So the answer here, you add it to that profit before tax to get cash flow before changes in working capital. So if I add it plus 4460, I get 5360. 5360. And then we have got changes in working capital. Changes in working capital. Changes in working capital. We can look at increase in inventory. Increase in inventories. Increase in inventories. You can see it was 200. Of course, anytime there's an increase, you deduct. There was decrease in trade receivables. Decrease in trade receivables, which was 40. Then payables, there was a decrease in payables. There's a decrease in payables or in trade payables. Decrease in trade payables, of course you deduct to 60 because when you are reducing your trade payables, it means you are paying more of your creditors or your suppliers. So when you are increasing more inventory, it means that you are buying more stock. So notionally, cash is moving out. Decrease in receivables. it means that your debtors are paying, because anytime a debtor decrease, they're paying, that is, so notionally money is coming in, cash is coming in. So negative, this will be, let's calculate that one for 60 minus 240. You get to 20, negative 220. And then you can get cash flow after changes in working capital. So 5360 minus the answer, you get 5140. From there, we can now look at tax paid. Tax paid was this working here. Our tax paid was 720. Then you can get cash flow. I think that was the only operation. Net cash flow from operating activities. Net cash flow from operating activities. So minus 720, you get 4420. Now, so that is our cash flow from operating activities. Let's look at cash flow from investing activities. Again, I'm going to rub this section. Cash flow from investing activities. The only working here that is demanding is associate 140, dividend, and also PP 320. So cash flow from operating activities. Cash flow from investing. So cash flow from investing activities. Cash flow from investing activities. So here we are going to have cash flow from investing activities. Again, we can look at the first one. You can say cash paid to acquire subsidiary, or razak. You can call it razak or subsidiary, which was 600 or 6 billion shillings in millions, or 6,000. Of course, cash went out. And then, of course, we have got cash received from disposal. Cash received from disposal of Salama now. Of Salama was 3512. We did it in our working. I think it was our first working. 3512. And then cash dividend received, or you can say cash paid to acquire PPE. This was our working again. It was 3200. So cash went out. And then we have cash received from disposal of PP, which was 1,000. Then dividends received from associate. Dividend received from associate company. We found it to be associate company. We found it to be 240, if I'm not wrong. And then dividend paid to NCI. That's the working also we did, which was 212. And then you can now get net cash flow from investing activities. Net cash flow from investing activities. So let's work it out. 600 negative plus 3512 minus 3200 plus 1000 plus 240 minus 212 minus 212 get 4460. 4460 because negative cash went out. Let's finalize the cash flow from financing activities. Cash flow from financing activities. Of course, here we look at shares. There was no any other shares that were acquired, but there was loan. There was a loan which they acquired from. So cash received from bank loan. Cash received from bank loan. Bank loans. Of course, you can just look at it. It was 200, 2000 minus 1200. So some cash came in, which is 800. And then dividend paid. Dividend paid to majority shareholders, majority interest. Paid to majority interest. We found it to be 500. So that's part of working. And look at net cash flow from financing activities. Net cash flow from financing activities. It was 300. Oh, there is something I've forgotten. Sorry, there's something I forgot. When they were acquiring Razak and when they were disposing Razak, Razak came with cash and cash equivalent amounting to 320, while Salama went, at the time of disposal, Salama went with cash amounting to 200. So that should be included here in cash flow from financing activities. Let me try to fix it here. Net cash flow, net cash received from disposal and acquisition. Razak, it was 320 minus 200, which is 120. So 120, if I add 120 plus 120 here, I'm going to get 4540. If I add that 120, I'm going to get 45. 45. So let me try to do it again. 120 minus 6,000 plus 3512 minus 3200 plus 1000 plus 40 minus 212 212 4540. Get 4540 negative. So let's now look at of course cash and the cash equivalent. Cash and cash equivalent for the year. Cash and cash equivalent for the year. We're going to add this net cash flow. This will be 4420 minus 4540 50 plus 300 plus 300. So we're going to get, so this answer plus 4420 plus 300. You get 180. So cash and cash equivalent for the year, you get 180. And then cash and cash equivalent balance go down. Cash and cash equivalent balance go down. So from the question, cash and cash equivalent balance go down in our statement of financial position was 360. Was 360. And then you finalize the cash in the cash equivalent, cash and cash equivalent balance carried down, which if you add them, of course, you get 0 for 540. So you can see we have got the question, we have got the answer, that is 20 marks, because our cash and cash equivalent for the year was 180, and then the cash and cash equivalent balance brought down was 360. If you add them, you get 540. So you can see our balance carried down, cash balance carried down is the same as the one in 2019. So that's how you are solving that question. It was not hard. You just need to balance these few things and then you go about it. So until we meet next time, goodbye.